So every few months, the media will come up with something new to scare retail investors with. And first, of course, it was COVID for the last 2 years. Then it was, okay, COVID's over. No one's talking about COVID anymore. Now it's like rising inflation. Oh my God. And then rising interest rates. Oh my God, we're going to die. And sure enough, the market went up when they actually raised interest rates, like I told you guys before. And then, of course, the war in Ukraine, right? So everyone's focused on that, but then market bounced back from that again. But you know what? The media will always find something new to scare investors with. So what's new? What's on people's minds right now is the treasury yield curve has started inverting. So the 2-year treasury yield has gone above the 10-year treasury yield, creating what is known as a yield curve inversion. And what the media tells you is that it's the greatest predictor of a recession. So how true is this? Does this signal an imminent recession and a bear market? And if it does, what shall we do to prepare? Let's discuss this in this video. So for those of you who are wondering what the hell is a yield curve, it's basically a chart that shows you the different interest rates, also known as yields. So yields is a fancy word for interest rates. The different yields that are paid by US government bonds, known as treasury bonds, at different maturities, which you can see on the x-axis. These are the maturities. So for example, if you buy the 2-year government bond, what's the interest rate you get currently? You get interest rate of 2.35%. So that means if you lend money to the government for 2 years, they pay you 2.35% interest. Okay. Now, if you buy the 10-year government bond or treasury bond, would you expect a higher interest rate? Of course. If I lend money for longer, I want more interest, right? So in this case, sure enough, the 10-year bond pays an interest rate of 2.41%, higher than the 2.35% on the 2-year bonds. So this is what we call a normal sloping yield curve, where the longer the maturity, the longer you lend money, the more interest you get. But sometimes something crazy happens, which is the interest or the yield on the long-term bonds, like the 10-year bond, falls, right? So for example, from let's see, where is it right now? On the 10-year, yeah, over here, right? So from 2.41%, let's say this falls to 2%. So if you lend money for 10 years, you only get 2%, right? But on the shorter term bonds, like the 2-year, it stays there or it goes up to say 2.5%. So what happens now? Now you have got what is known as an inverted yield curve, which means that the longer term bonds pay less interest than the shorter term bonds. So usually this is a sign that people expect bad times. People expect a recession. Why? Remember I taught you in my last video that bond prices move the opposite of bond yields or bond interest rates. So when bond prices go up, the yields go down. When bond prices go down, the yields go up, right? So when you see the long-term yield going down, causing the inversion, is because long-term bonds are going up. So why are long-term bonds going up? Long-term bonds go up when people fear a recession, so they sell stocks which they think are risky, and they buy safe haven bonds. So when everyone is buying the long-term 10-year, 20-year bond, everyone's buying the bond, what happens? The bond price goes up and the yield comes down. So when the yield comes down lower than the shorter term yield, you got a yield curve inversion. And that's why it's known as a predictor of a coming recession, because people are buying long-term bonds as a safe haven to prepare for the recession. So what people often look at would be the 10-year versus the 2-year yield. Now don't ask me why, it's just a convention, right? So as long as the 10-year is above the 2-year yield, well, they say it's safe, it's normal sloping, right? But if the 10-year long-term goes below the 2-year, that's a yield curve inversion, and that's supposed to be a predictor of a recession. So people are always looking at the 10-year minus the 2-year, and the moment this turns negative, that means that the yield curve has inverted. So is this yield curve inversion a good indicator of a coming recession? Let's take a look at this chart. So on this chart, you can see this is the 10-year minus the 2-year spread of the treasury yield. So what it means is that when this goes below zero, there's a zero line, that means the 10-year is now below the 2-year and the yield curve has inverted. All right, now how many times has this happened? In the last 30 years, it has happened 8 times. And out of the 8 times, it brought on 6 recessions. So you could argue, hey, 6 out of 8 is 75% accuracy. So 75% of the time, this inversion leads to a recession. Yeah, well, yeah, that's true. But then again, it's a very small sample size. It's only 6 recessions. It's only 8 inversions. So, you know, it's a very small sample size. That's the first thing. Now, let's take a look and let's see what we can learn from this. Now, again, when did it invert? Now, it inverted in 1978 here, and that led to this recession. This shaded area is a recession. Okay, so this led to a recession. Then it went up and then inverted again in 1980, and this, you could say, led to this recession over here. All right. Then it inverted again in 1982. Now, this one did not lead to a recession. So this was didn't work, right? Okay. Then inverted in 1988, and you can say, oh, led to that recession over there. Inverted again 1998, but this one did not lead to a recession, so that didn't work. This one inverted, boom, led to this recession. This one inverted, led to this recession. And of course, the most recent was 2019, when it inverted over here and led to the COVID-19 crash recession that was really quick. People are now freaking out because they say, hey, now this spread has turned negative on Tuesday and on Thursday. So it's going to be a recession. Wait. It turned negative for a few hours on Tuesday, a few hours on Thursday, and now it's back to normal again. All right. So the first thing to understand is that this inversion is only a good indicator if it stays negative for some time, for at least, I would say, 1 to 3 months. All right. A quickie inversion means nothing. It has to stay inverted for a sustained period of time. In fact, if you take a look at this chart, you can see that over here, it turned negative as well, right, for just a few days. And this, again, did not lead to a recession because, again, it was not sustained, right? Now, in 2019, you can see it also didn't stay there for very long. It touched and it went up. Maybe you say, but Adam, that led to a recession. No. If you actually look at the numbers, this did not lead to this recession. This recession happened because of COVID, right? This happened to be a freaking coincidence. If not for COVID, this would not have led to a recession. So the first thing to understand is that an inversion has to stay there for a few months like this. This was more reliable, stayed there for a few months, a few months, a few months, a few months. All right, so that's the first thing to understand, and why I'm not really calling a recession just yet, unless we get negative for a longer period of time. Now, the second thing to also look at is this. In all previous inversions, the reason it inverted is because the 10-year yield dropped below the 2-year yield, right? But in this particular instance, the 10-year yield is not falling. In fact, the 10-year yield is rising very, very strongly, which means that people are selling the long-term bonds. I showed this chart in my previous video, which is the bond ETF. People are still selling bonds. So when people are selling bonds, it means that they are confident about the economic growth of the future. So that's why this inversion is not the same as the other inversions. In the other inversions, bond prices went up, long-term bonds went up, and the long-term 10-year yields went down. So in other words, unless I see the 10-year yield start to come back down, and unless I see that the bonds start to reverse to an uptrend, then this inversion may not be a very good indicator of a coming recession. If this time the yield curve really stays inverted for some time, is it a good way to time our exit from the market and to get back in after the market crash? Well, not really. It's an indicator, but it's not a very good way to time the markets, and I'll show you why. So let's take a look at all the previous 8 yield curve inversions and you see what I'm talking about. So let's begin from 1978. So 1978, you can see the yield curve inverted on the 18th of August. So after the inversion, how long before the recession started? Well, the recession started here. This red shaded area, that's a recession. It started in 1980 January. So it took more than 1 year for the recession to start. But we don't really care about the recession. As investors, we care about, okay, where's the top of the market? We want to get out at the top before the crash, right? Well, after the inversion, the market top happened after 18 months, which is 1.5 years later. And during that time, the market gained 14.5%. So it was a long time later, it was not immediate. Now, how about the next one? Let's look at the next one. So the next inversion happened in September 1980 over there, okay? And the market topped 2.5 months later. And from the inversion to the top, the market went up 13%. But the recession only started in July 1981, which was many more months later. So in this case, the bear market actually started before the recession started. And you had 2.5 months buffer before the market came down. So the first instant, you had a 1.5 year lag time. This one, you only had a 2.5 month lag time. So it's different each time. How about the next one? So the next one, market inverted in January 1982 during a recession already, all right? So it did not predict the recession. Now, after it inverted, there was no recession after that. So this one did not lead to a recession. Next one. Next one was yield curve inverted, 14 December 1988, right here. And how long before the market eventually topped and the recession started? It was 19 months this time. So now it was 1.6 years after inversion, 1.6 years later, then the market went to a bear market, then the recession started. So if you had sold here because of the inversion, you would have missed out on a 34% gain waiting for the crash, waiting for the recession. Next one would be 1998, market or yield curve inverted here, and market kept going up for another 1.3 months, gained 6.6 more percent, and market topped in 1998, but it did not lead to any recession. And it wasn't a bear market, it was actually just a correction. Now, why is this not a bear market? Because the market didn't close more than 20% below the high. It just went down 22% intraday and then went back up again. So this did not lead to a recession, did not lead to a bear market. Just a quick correction. Next one, the next inversion happened in 4 February 2000 here. After the inversion, the market topped 1.6 months later. So this was pretty fast after that, right? And the market went up another 11%, market topped and then came down. But the funny thing is the recession only started in March 2001, quite a while after the market topped. All right, so the next one was February 2006, inverted over here. And the market topped only 1.7 years later. So this time, again, a long way. So again, imagine if it inverted, you say, okay, let's sell. And if you sold, you would have missed out another 22% of gains in the market. And you would have had to wait 1.7 years before the actual bear market start. Okay, the most recent inversion happened in August 2019. Now, this was not a proper inversion because, like I said, it just touched and went up, didn't stay there for very long. And you may say, but Adam, this led to a recession, right? And it led to a recession 5.8 months later, and the market topped again 6 months later after an 80% gain. Now, again, to me, this crash And this recession is a coincidence. It was not because of this inversion. This was caused because of the COVID pandemic that no one could have predicted, and it was purely a coincidence, right? So to summarize, if you take a look at this table, you can see once the yield curve inverts, can we time our exit from the market? Can we call the market top, get out, and then get back in when the market bottoms? No, we can't. It's a terrible timing tool because from the time of inversion to the time of the market top, it could be anywhere from 18 months, right? 1.5 years to just 2.5 months to another 1.6 years to another 1.7 years to another 1.6 months. There's no way to know, right? It's kind of like saying, okay, when you eat a meal, I can predict you're gonna take a shit. Of course, after a meal, you're gonna take a shit, but you don't know when you're gonna take a shit. It could be 10 minutes later, it could be 1 hour later, it could be 8 hours later, it could be 3 days later. I know people who only shit once every 3 days, but sure, after a meal, you're gonna shit. But let me ask you this question. Does it mean that every time you eat a meal, you have to go to the toilet straight away and wait for the shit to come out? Of course not, because yeah, the shit could come out now, but you could be sitting in the toilet for 3 days and no shit, right? And all that time you're wasting your time in the toilet when you could be out there doing productive things and making things happen. So the same thing in the stock market. Even if we do get an inversion, it doesn't mean that one should sell straight away because again, the actual top could come months or years later, and staying out of the market, you miss out on a lot more gains. So a lot of people, they wish that, hey, you know what? I can, jump out at the top and buy back at the bottom. And everyone wishes that, right? But there's no real way to really time the markets that way. And research has shown that people who attempt to jump in and out the markets, right? Trying to sell at the top, buying back at the bottom, in the long run, they always end up losing money, or they end up making a lot less compared to just staying in the markets. So that's why this very famous saying from Peter Lynch that far more money has been lost preparing for corrections and getting out too early, or trying to anticipate corrections, than lost in the corrections themselves. And think about it. If you hold fundamentally good businesses, even during a correction or bear market, you're not losing money. If you don't sell, you don't lose the money, right? Because you know that it's a temporary drawdown. If you're holding good businesses, they will always bounce back up higher eventually. So you want to take those instances to either just hold, ignore the market, or do dollar cost averaging. Keep adding more shares at lower prices because eventually, after the bear market, when the bull market comes, your returns will be even higher. But if you try to get out, get back in, more often than not, you tend to get back in at a much higher price, or you never get back in at all anymore and the market leaves without you. So in my investment portfolio, I don't intend to sell because I predict a recession, I predict a bear market, right? Because I hold solid companies in my portfolio. I've got a diversified group of companies that are all fundamentally great companies, and I know that even if the price goes down temporarily, it's no big deal. I'll just add more shares, dollar cost average down, because they're going to bounce back even higher eventually. So what's very important is to ensure that in your portfolio, the majority of your stocks must be having low debt and very, very profitable and positive cash flow. Sure, you can have a few speculative stocks, but just a small part of your portfolio. At the same time, if you feel that, hey, you know what, the recession is coming soon, what you can do is to ensure in your portfolio, you have more defensive stocks. Now, what are defensive stocks? These are stocks where during a bear market, they don't go down that much, or they may even go up during a bear market. So they defend your portfolio. So I tell my students in your portfolio, always have enough defensive stocks to buffer the short-term fall of your more cyclical or speculative stocks. So let me end off this little sharing by showing you, for example, if you take a look at the last 3 recessions, what were some defensive stocks that you would want to have in your portfolio? So during the dot-com crash, this led to a bear market recession from 2000 to 2001. So this is the S&P 500 going down about close to 50%. But what stocks went up during this period, or at least didn't go down that much? Well, these are the stocks. There we are. You can see the S&P going down almost 50%. But Walmart actually went up, as you can see, right? Johnson & Johnson, Colgate, Pepsi, TLT, which is the bond ETF, which I talked about in the last session, right? Procter & Gamble, Clorox went down as well, but went down only like 2 or 6% versus 50% in the market, right? In the S&P, right? Costco and Yum Brands went down as well, but again, not as much. So these are defensive stocks. Now, every recession is slightly different. The next one was the financial crisis, where the market fell more than 50%, S&P, but what stocks held their own, right? So again, you can see S&P went down 50%. Again, what went up? Again, the bond ETF, TLT. Again, Walmart, right? McDonald's is a pretty defensive stock because in a recession, people still go to McDonald's, right? And interestingly, Amazon, although it's a growth stock, but it's pretty defensive as well. So Amazon did go down, but only went down 13% compared to more than 50% for the overall market. And again, you got Colgate and Clorox and Johnson & Johnson and Yum Brands and the usual defensive stocks. The most recent recession that happened really fast was the COVID crash. Now, again, what stocks did not go down during the COVID crash or went down slightly? Again, you have got your TLT, your long-term bond ETF, and that's why I said that when long-term bonds get really cheap, it makes sense to add a bit of it to buffer your portfolio during a bear market. Clorox, for obvious reasons, because pandemic people want to spend on cleaning. Walmart, right? And Costco, and again, Amazon, Dollar General, Procter & Gamble, they went down a lot less. Okay? So in general, if you look at all the past recessions, I would say the most consistently defensive stocks are Walmart, Dollar General, and interestingly enough, Amazon. Okay, so to summarize, don't freak out just yet. Yes, the yield curve has inverted for a few hours, but it's not stayed there long enough to be significant. And even if it stays there and we anticipate a recession is going to come, you never know when it's going to come. It could be, again, 2 months later, could be 18 months later, could be 1.5 years later, right? So it doesn't make sense to get out of the market because you may miss out on a lot more gains and attempt to get back in again. So what's more intelligent is to make sure that you have a well-diversified portfolio of great businesses and defensive companies so that during a temporary correction, your portfolio goes down less in the market and use the opportunity to add more shares. So in the long run, you compound your wealth over time. At the same time, I highly recommend that you start to learn and master options right now. Take our options courses, come to our options community, because with options, you can generate consistent profits even when the market goes sideways and the market goes down by employing a lot of very powerful strategies like using covered call strategies or using ratio spread strategies or bear put option spread strategies. So with options, you are able to so-called generate profits during a correction without selling your stock. So with that, hope you've learned something. May the markets be with you. Remember to subscribe. Join our courses at piranhaprofits.com and we'll be with you in the community helping you every step of the way. May the markets be with you. If you want to catch my latest videos, click on the subscribe button right now. Click on the bell so you get instant notifications once I upload my latest video. If you want to check out my online courses, go to piranhaprofits.com where you're going to learn how to invest and how to trade the financial markets and create an income from all around the world. If you want to join my live Wealth Academy program, go on to wealthacademyglobal.com and find out more about how you can learn investing and trading live online. This is Adam Khoo, and may the markets be with you.